Okay, we were discussing about consolidated profit and loss account. We have discussed if there are intergroup transactions, we need to eliminate from sales, from cost of sales, and unauthorized profit part we need to add with cost of sale. And at the end, the consolidated profit we need to show distribution between non-controlling interest based on subsidiary profit and profit share for parent company owners. Transfer of non-current assets within the group. Parent company transfer asset to the subsidiary, subsidiary company transfer asset to the parent company. And due to that transfer, if they have recorded any profit, we need to eliminate in consolidation from other income. Impairment of goodwill. There is impairment of goodwill. In consolidation, we need to record that impairment loss in operating expenses. Meanwhile, adding expenses of a parent subsidiary, we need to add impairment in operating expenses. If there is any fair value adjustment, like at the time of acquisition, subsidiary asset carrying amount is different, fair value is different. And due to that, if there is any extra depreciation that we needed to record because carrying value was lower, fair value was more. So extra depreciation we need to add, and that depreciation will be recorded in cost of sale. If examiners say this should be charged to operating expense, we will charge to operating expense. Otherwise, always excess depreciation we will adjust where in cost of sale relating to fair value adjustment. And if there is any professional fee, if there is any professional fee involved in acquiring the subsidiaries, that should not be capitalized. That should be recorded as expense in parent company financial statement. If it is recorded in investment, we should eliminate it from investment. Any professional fee involved, any legal fee involved in acquiring the subsidiary, that should not be capitalized. And any deferred consideration should be calculated using a present value method. And we need to record the finance cost in profit and loss account, like expense debit and liability credit, means should be added to the liability and recorded as expense. So let's move toward this test your understanding one. What we need to do, prepare consolidated statement of profit or loss for the year ended 31st December 20x7. Set out below are the draft statement of profit or loss of Prunes and its subsidiary company Sultanas for the year ended 31st December 20x7. On 1st January 20x6, what's the year end? 31st December 20x7. 1st January 20x6. This is 1 year and this is second year. Currently, we need to prepare here 31st December 20x7. So at 1st January, mean here 1st January 20x6, here 31st December 20x6. So at 1st January 20x6, Prunes purchased 75,000 of Sultana's total share capital of $100,000 one ordinary shares. Mean Here they acquire. So acquisition is done here. How much? 75%. Statement of profit or loss for the year ended, revenue for both companies, cost of sale for both companies, gross profit, operating expense for both companies, finance cost for subsidiary only, income tax expense for both companies, profit for the year. But just me one. During the year, Sultana's sold goods to prawns, subsidiary sold goods to parent company. For 20,000, making a markup. Markup is always on cost, margin on sale of 1/3. Markup of 1/3. Only 20% of these goods were sold. This means 80% still remain. At the year end, the rest were still in inventory. So first 20,000 we need to deduct from here. We need to deduct from here. Figures are in the already 1,000. So this means 20 we need to deduct. What is the unrealized profit? One third is profit. $5,000 is the profit. So this means from that 5,000, 80% still remain. So what is unrealized profit? 5,000 into 80%, that is what? 4,000. So this means 4 we need to add here as unrealized profit. So this adjustment done. Is that? Yes. Goodwill have been subject to an impairment review at the end of each year. Since acquisition and the review at the end of current year revealed a further impairment of 5,000. Impairment is to be recognized as an operating cost. So this means from operating expenses, we need to add one more expense that is relating to goodwill 5. Impairment goodwill. At the date of acquisition, a fair value adjustment was made. And this has resulted in additional depreciation charge for the current year of 15,000. At the rate of acquisition, carrying value was lesser, fair value was more, and due to more fair value, 15,000 additional depreciation required. Additional depreciation required. It is group policy that all depreciation is charged to cost of sale. So we need to add 15,000 in cost of sale. An extra expense should be recorded there. Prunes value the non-controlling interest using the fair value method. So C. So revenue we can calculate how much? 880. Cost of sale? 499. So GP will be 381. And operating expenses will be 50 plus 93, 143. By deducting this, we can arrive at 238. Is there any information about this finance cost, whether it is relating to intergroup? No, this means this is outside group. So will be there. So 235 and tax will be 82. So profit after tax will be 153. From this, we need to deduct share of non-controlling interest. No, non-controlling interest, profit share. There are some adjustments with net assets at acquisition. We need to calculate this non-controlling interest. How? At the start of the chapter, they provided some information. They provided some calculation. This how non-controlling interest will be calculated in P&L. We need to see what is the subsidiary profit that is already given in the question. From that, if there is any fair value excess depreciation, we need to deduct. We need to deduct any unrealized profit if subsidiary sold goods to parent company. We need to deduct impairment, and this will be adjusted subsidiary profit. From that, we need to calculate non-controlling interest share. So in subsidiary profit, we need to adjust fair value depreciation, unrealized profit, and impairment. And in this question, all three things were there. So what was the subsidiary profit? If you see, test your understanding one. So I'm going to perform working here, working one, non-controlling interest. So subsidiary profit was 80 and excess depreciation due to fair value measurement, that was how much? 15. What was unrealized profit due to intergroup transactions? That was 4. Was there any impairment? How much? 5. If we deduct this, we arrive at 56. That is attributable to others. So non-controlling interest is how much? 25%. So what is 25% of this? 14. So this should be recorded here, 14. So remaining is parent company profit share. How much? 139. There is no information for this. Like in previous question, there was only intergroup transaction, but that was sold by parent company to subsidiary. So there was no adjustment in subsidiary profit. So we need to see while calculating non-controlling interest, we need to make adjustment first with the subsidiary profit. And through adjusted profit, we need to calculate non-controlling interest here. So let's move forward. Test your understanding too, don't need to do that. If there is mid-year acquisition, acquisition during the year, each line by line item of subsidiary, we need to apportion according to those months. Test your understanding 3. Yes. What we need to do, prepare the consolidated statement of profit or loss for the year ended 31st March 2027. So paper bought 70% of salt on 1st July 2026. The following are the statements of profit or loss of pepper and salt for the year ended 31st March 2087. 70% holding. We need to prepare at what date? 31st March 2087 when they bought 1st July. 31st March 20x7. So they bought on 1st July 20x6. 9 months acquisition, not completely. So 3,1,200 plus this will be multiplied by 9 by 12. Plus this will be multiplied by 9 by 12. Plus this will be multiplied by 9 by 12. Investment income, we need to see whether it is from subsidiary, we will remove that. And income tax, this will be multiplied by 9 by 12. The following information is relevant. On 1st July 20x6, an item of plant in the books of salt had a fair value of 5,000 in excess of its carrying amount. At this time, the plant had a remaining life of 10 years. 500 is annual depreciation that we need to record. Depreciation is charged to cost of sale and where it should be recorded in cost of sales. So 5,000 divided by 10 years is equal to 500 per annum. So we need to charge for 9 months. That will be 375 where it should be added. Cost of sale. Is that? Okay. During the post-acquisition period in after July, salt sold. Who is the salt? Subsidiary. Sold goods to paper for 4,400. On this amount, 500 was included in inventory of paper at the year end. Salt earns a 35% margin on its sale. So first we need to deduct 4,400 from both. What is unrealized profit part? 500 remaining into 35%. Simple on margin. Yeah. How much is that? What we need to do with that? Simple. Goodwill amounting to 800 arose on acquisition of salt, which had been measured using the fair value method. Goodwill is to be impaired by 10% at the year end. 80. Impairment loss should be charged to operating expenses. Okay, no issues. We'll add 80 here. Salt paid a dividend of 500 on January 120x7. To whom? Parent company. Is there any other income? They have shown investment income of 2,000. This means 500 dividend they received. Complete 500. Now we need to portion. Complete 500 or we need to portion. Obviously, they paid, prepared the consolidated statement for profit and loss for the year ended 31st March 20x7. So on 1st January 20x7, they paid during the year. No? Don't need to portion that. Because if they paid on 1st January, usually they acquired before 1st January. But they paid how much total dividend? 500. Parent received complete 500 or their portion only? Their portion obviously they pay to all the shareholders. It doesn't say pay to parent company this 500. Paid 500, this means to all shareholders. So out of this, 75% is of parent company. 70% or 75%? 70%, sorry. Holding is 70%. So this means 350 we need to deduct from here. Dividend received from subsidiary is like you are transferring money from one pocket to other. Is that? Yes. Can you calculate, please? $34,600 is the revenue. Cost of sale is 1815. 1815. If you deduct this, you can get GP 1645. What is operating expenses total? 10980. So we can get profit from operations 5470. 5470, and this will be 1650. Yeah. Profit before tax will be 382. We deduct the tax. Two four seven five. So profit after tax 345. Much? 1345. 1345. Is that 1345? Can you check your calculation again, please? Yeah, watching. Is that investment income we need to deduct or add? Now, if you deduct tax, 4641. 4641. Yeah. You said the current income does deduct. I think you said that dividend received is from subsidiary. From subsidiary. In intergroup dividend, we need to eliminate because it's included in this 2000. So we need to eliminate because they have shown investment income. I mean, wherever they made investment in subsidiary as well. Okay, what is non-controlling interest? Working well. Subsidiary profit. What is that? 1100. From that, we need to deduct unrealized profit subsidiary made in a, that is 375. From that, we need to deduct impairment. How much was that? 80. Yeah. What else? Depreciation. Yes, excess depreciation. How much was that? I think unrealized profit was 175. Depreciation was 375. If we deduct all these, we can find adjusted profit. How much is that? 470. Sorry, subsidiary profit, we need to apportion, not complete. 9 by 12, 825. Now see what's the total. 195. Out of this NCI share, how much is the NCI holding? 30%, 58. So here we will say NCI profit share is 58. So parent profit share is what? 4587. 4587. Is that? Now moving towards another topic called other comprehensive income, consolidated other comprehensive income. The same way we need to prepare other comprehensive income as we normally prepare. After calculating profit, we put heading other comprehensive income. If there is any revaluation gain loss, we need to record, and then we need to show total comprehensive income. But in consolidation, that total comprehensive income also we need to divide into NCI and parent company. Like below this, whatever we have done now, below this, we will put a heading other comprehensive income. In other comprehensive income, we need to add revaluation surplus with profit after tax. So we will record profit after tax. What was that? This was profit after tax. 4645. We will adjust whatever is the revaluation surplus or something like that. We will calculate total comprehensive income. After calculating this, we need to distribute this. What is the share of NCI? What is the share of parent? How? The same question that we have covered test your understanding 3, they have added some information. Additional information. Salt's land increase in value by 500 over its value at the date of acquisition, and there was a loss on its financial asset held at fair value through other comprehensive income for the year of 100. There was revaluation gain of 500, and there is a loss on financial asset held to other comprehensive income. So Salt's land increased in value by 500 over its value at the date of acquisition, and there was a loss on its financial asset held at fair value through other comprehensive income for the year of 100. We acquired during the year. This loss is for the complete year. This means this happened at the date of acquisition. This gain will be recorded full. But this loss we need to apportion. How much? 75. All items are deemed to accrue evenly throughout the years. You need to prepare consolidated statement, profit or loss, and other comprehensive income. So first we prepare statement of profit or loss like this. And then in that we added the gain on revaluation of land, deducted loss on financial asset. This is total comprehensive income. So what was the share of NCI? We divided in that. This is for profit. That you can even show here as well. After that, we need to show how this other comprehensive income is distributed. How this other comprehensive income is distributed. What is total comprehensive income? 5070. Out of this, how much is the share of NCI? How they have calculated their profit share? And out of this 500, I mean, if you see all together, the main difference is 425. So into 30% is of NCI. How much is that? 58 plus 425, that is 30% of 425. So from this, we can get 425. That is what 186. So remaining is a for parent company. Mean 58 profit share. And relating to this revaluation amounts, how much is the share of NCI? 30%. But you added in other comprehensive income net 425. So 30% of this and 58 that we calculated through our working one. So this chapter is also finished. Let's move towards some question from BPP Kit. Copy the questions first. Question 267 to 274. 67 to 274. BPP Kit. Sixty-seven to 74. Okay. Good luck everybody with 267 question. 267. What is the cost of sale in Paprika consolidated statement of profit or loss for the year ended? You need to calculate cost of sale figure, please. The cost of sale figure we need to calculate. So 60,000 of parent plus 100,000 of subsidiary. We need to see what are the other adjustments. Paprika company purchased 75% of equity share capital of Salt company on 30th April 2024. Non-controlling interest are measured at fair value. The cost of sale of both companies for the year ended 30th April 2026 is given. When they acquired 30th April 2024, mean 2 years back. Salt company had machinery included in its net assets at acquisition with a carrying amount of 120,000, but a fair value of 200,000. The machinery had a remaining useful life of 8 years. At the date of acquisition, all depreciation is charged to cost of sale. So what's the difference between fair value and carrying amount? That is 80,000. Useful life is 8 years. This means 10,000 depreciation need to charge where cost of sale for the complete year, for this year only. During the year, Salt company sold some goods to Paprika for 32,000. So these 32,000 first we need to deduct from sales, from cost of sale at a margin of 25%. So what is 25% of 32,000? 3/4 of these goods remained in inventory at the year end. So 32,000 into 25% into 3/4. Unsold inventory. We need to add. Yes. Now give me the figure, please. Is that we have just covered this in the question. Nothing new. 268, please. How will this affect group's cost of sale in the consolidated statement of profit or loss? Mean what will be the effect on cost of sale mean by adding, deducting the net, whether we need to reduce or add cost of sale by adjusting all. Profit relating to unsold inventory. Whatever is sold, that has been realized. So 12 million intergroup transactions. This means we need to deduct this 12 million first. And with that, we need to add unrealized profit part. So these would had cost 9 million. This means profit is a 3. Total profit is 3. Now we need to see whether all remain at the year end or complete 3 will be unrealized profit. If some inventory is sold, then what is relating to unsold inventory? Okay, these goods had cost of 9 million during the year to 31st March 20x3. Staptic company had sold 10 million of these goods for 15 million. With whatever amount they sold is irrelevant because there's profit realized. We need to see how much inventory left relating to intergroup transaction. How much left? 12 out of 12, 2 left. This profit 3 million is for 12. We need to find for 2. What we need to do with the unrealized profit with cost of sale, add or subtract? Option. Is that? Unsold inventory. We covered this. Yes. In previous question. Okay, 269, please. What will be the effect on group's retained earning for the year ended dated to 31st December when this intergroup transaction is cancelled? We need to adjust this in. If there are any intergroup interest, dividend, profit, we need to eliminate. What should be the adjustment with group's retained earning, consolidated retained earning? Obviously, any expense income we adjust with consolidated retained earning because included in that through profit. Year end is 31st December. E? A? No. B? No. Okay, what happened? On 1st July 2087, year end is 31st December 2087. How many months? 6 months. Okay. Spider Company acquired 60% of equity share capital of Fly Company. On that date, made a 10 million loan to Fly Company at a rate of 10% per annum. 10 million is a loan amount. 8% is the interest rate. This means they recorded investment income, they recorded a liability loan, they paid interest, they received interest. So parent company provided loan to subsidiary. They recorded interest income and they recorded interest expense. How much? 10 million is the loan amount, 8% is the interest rate. So complete year interest is 800. Yes. 800 or 8 lakh? 10 million is the loan amount, 8% is the interest. What is that? 800,000 or 800,000? Take that 800,000. But for the complete year or for 6 months? For 6 months. So 6 by 12. So interest amount is 400,000 that they have recorded. They recorded interest income that we need to eliminate from consolidated. So from consolidated, interest income we need to eliminate. We should reduce or add with consolidated retained earning. Reduced. How much? 400,000. But subsidiary company recorded interest expense with 400,000. That should also be adjusted. But out of that 400,000, 60% is relating to consolidation. 40% is relating to non-controlling interest. In that expense was reduced, deducted while calculating subsidiary profit. So now we need to add back. But how much? Not complete. 60%. So add back interest expense of subsidiary. But how? 400 into 60%. What is that? 240,000. So net effect will be 160,000 we need to reduce. So retained earning will be reduced by 160,000. Because income, while calculating profit, is added. So that we need to reduce. But the expense recorded in subsidiary that was deducted to calculate profit, now we need to add back to eliminate it. But not full. Only whatever is coming here. 270, please. The total comprehensive income attributable to non-controlling interest. In P&L, how we calculate non-controlling interest, that you need to calculate. Subsidiary profit, we need to adjust excess depreciation, unrealized profit, impairment, adjusted profit. We need to calculate non-controlling interest part. Year end is 30th June. They acquired on 1st January. How many months? 6 months. At the date of acquisition, subsidiary had a building which had a fair value of 22 million and a carrying value of 250 million. 2 million is up. The remaining full useful life of the building was 20 years. So excess depreciation is 20 divided by 20. 1 million per year. 1 million or 100. 2 million is excess fair value. 20 year is life. Yeah, so 2000 divided. That will be 0.1 million, 100,000. And 6 months depreciation is 50,000. Profit for the year of subsidiary is 1.6 million. It's for the year. Yeah. So subsidiary profit, that is 1.6 million into 6 by 12. So that is 800,000. In that we need to adjust excess depreciation that we have calculated how 2 million divided by 20 years, that is 0.1 million multiplied by 6 by 12, that is 50,000. 50 we need to deduct. Company parent measures non-controlling interest at fair value at 30th June. It is estimated that goodwill in C was impaired by 500,000. So impairment is also there 500. There is no unrealized profit. So we can calculate 800 minus 500, 300 minus 50, 250. What is NCI share? How much? 20%. That is 50. Yes. Option. You covered in previous 2 questions. 271, please. Yes. What will be shown as gross profit in consolidated statement of profit or loss? You need to calculate consolidated GP. 46,000 is sale. Add these, 46,000, 46,000. What is unrealized profit? 46,000. There is a markup. Multiply by 30 by 130 and 25% still unsold. So what is that? Unrealized profit. 26. So that should be added here, 2654. Calculate amounts. No. Year end is what? 31st December. When they acquired. How many months? 10 months. So this should be multiplied by 10 by 12. This should be multiplied by 10 by 12. Now calculate both figures and then GP. So first calculate 421,500 multiplied by 10 by 12, then add 955,000 minus 46,000. 1260, 250. What is cost of sale? First 214,600 multiplied by 10 by 12 plus 407,300 minus 46,000 plus 2654. Five, 4, 2, 787. What's the value of GP? Simple. 272, please. Only 3 questions more. What is the amount attributable to non-controlling interest in the consolidated statement of profit or loss? Sorry, no. How much will be the unrealized profit decrease the profit attributable to non-controlling interest for the year? Unsold inventory. And you need to calculate non-controlling interest part. So 30th, so September 2021 is the year end. P acquire S on 1st June 20x1. June to September, June, July, August, September, 4 months. Sales from S to P, subsidiary to parent company, throughout the year ended 30th September 20x1 were consistently 1 million per month. This means 1 million per month into 4 months, so 4 million is the same. S made a markup on cost of 25% on these sales, 25 by 125. At 30th September, P company was holding 2 million. Out of this, 2 million they were holding. So 25 by 125. Total is 400,000. What is the NCI share? 20%. What is that? 80,000. Is that 273, please? Is the amount attributable to non-controlling interest in the consolidated statement of profit or loss? B company has owned 70% of D company for many years. It also holds a 5 million 8% loan note from D company. The financial statements of D company, means subsidiary, shows a profit for the year ending 31st December 20x6 of 1.3 million. So what is a D profit? That is 1.3 million, 1300. This means they provided a loan to parent company. This means they recorded interest income that we need to adjust. How much income they have recorded? 5 million is a loan into 8% for the complete year. They have recorded how much? 400. So we got the adjusted profit, that is 900. And NCI share 30%. How much? 270. B company acquired 80% equity share of Y company on 1st July 20x6. Year end is 31st December. 6 months before, the financial statements of Y company show a profit for the year 2.4 million. So Y is a profit that need to be consolidated Out of this 2.4 million, 2,400, how much? 2,400, how much? 6 by 12. How much is that? What is share of NCI? What is 20% of 1,200? If we add 270 plus 240, last question 274, Pearl Company has controlled an 80% owned subsidiary, Silver Company, PS, 80%. For many years, Silver Company sold goods to P. So subsidiary sold to P. 120,000 at a markup of 20% for the year. P company had sold half of these goods by the year end. So 120,000 multiply by 20 by 120 and 50% is remaining. 10,000. Yes. Unrealized profit. Okay, which of the following statement regarding intra-group transaction in the consolidated financial statements are true or false? Revenue must be reduced by 120. Yes. Cost of sale must be reduced by a total of 110. By a total of 110. 120 had 10, so 110. Net. Non-controlling interest must be reduced by 2,000. That's it for today. Sorry for taking 14 minutes extra. That was due on your paper 3 days before. So balance. So see you again on Tuesday.
And the time, sir?
Tuesday 5:30 to 9.